Hello, everyone. Can you hear me? Will the sound come out? Steven, Mutua, Wajahi Samuel.
Yes, can hear you.
You can hear me clearly, yeah?
Yes.
So let's wait for your friends. I hope they are logging in. Let's give them like 5 minutes, please.
Okay.
Pitake Kaga, can you hear me? Pitake Kaga. Pitake Kaga. Roy Ogiri, can you hear me?
Steven Mutua.
Yes, Steven Mutua, yes.
Yes.
Gekanga Peter, can you hear me? Evanson Jiro, can you hear me, Evanson?
Yeah. Yes, I can hear you.
Okay, so let's wait for your friends. Maybe you can give them 4 or 5 minutes and see how many will have managed to log in.
Okay.
Can you see something on your screen? Can you see the additional notes?
Yeah.
Yes.
Are they clear?
They are clear.
They are clear on your side.
Yeah.
Anyone whose notes, they cannot be able to view them clearly. Why are the ladies? Because I can see nyinyi ni vijana tu peke yenu. Ivanson,
Never.
why are the ladies? Are they not registered?
Maybe I was doing ilianza 3.
They are not aware, but I think in the port it is indicated clearly. As I can see, and
Oh,
Jockey is in.
maybe I text in the group.
Yes, can you text them? Tell them we are giving them more than 5 minutes. By 3:15, we are going to start.
Okay.
And Jockey, Doreen, Motiria.
Poa.
Can you hear me, everyone?
Kuja Mkuru akachukua gari ya Thika. Hapo before Thika kulikuwa na road block.
Can you hear me, please?
Wakaulizia akamwambia it's safe in Nairobi, just left to see.
Can you hear me, please?
Yeah.
Yes, I can hear you.
Okay, so we are going to start. I'm going to first mute all of you. Then you're going to maybe unmute yourself when I request you to do so. Maybe when I need you to answer a question or I need a clarification. So allow me to first mute all of you to help us maybe communicate clearly. So this is the topic is also parts of the sources of business finance. I believe you can see on your screen what you're talking about. And I believe even if you're not there last week when you were discussing the introduction to business finance, I hope you have updated yourself. There are the various audios. Audios are very important. For an audio, I have tried to explain some concept in detail. So always make it an effort. Make it an effort to always download those audios, even if you have the notes with you. So for those who are asking about the audio 2 on the topics of business finance, I've made the correction. I believe now you can be able to play that audio. And in case there's still a problem, just let me know in the public chat forum. Anyone who have downloaded the audio, the second audio, is it clear? If you have downloaded the second audio, please let me know in the public chat forum that you are able to listen to that audio. If you have downloaded the second audio, Sources of Business Finance audio continuation. If you have done that, please, and you have listened to that, just to make sure it is clear now, can you let me know in the public chat forum? So when you're talking about this topic, sources of business finance, you just need to understand, as a company, where do they get the various finances from? That is what we mean by source of funds. That is also finance. So that's why we in our notes we are told that sources of finance means the way for mobilizing various terms of finance to the industrial concern. So as a business, where do you get your finances from? Maybe to fund your investments or for your day-to-day operations of the business. And now after that, we are saying now they can be classified under the various categories. And the first category we classify our sources of funds is now based on the period. And based on the period, we have two types. We have long-term sources of finance and we have short-term sources of finance. So allow me first to please mute your audio, please. Mute your audio, please, so that you can be together. So we are saying that now the first category is based on the period, and based on the period we have two types: long-term sources and short-term sources. I'm still trying to share that page on your screen, so bear with me, please. And the long-term sources, there are those sources of finance that are likely to be or repayable over a period of a long period of time, mostly more than 5 years. So we are talking about those sources of finance as a company. When you get that source of finance, it is repayable for a period of more than 5 years. As simple as that. So those examples are many. We have the loans, we have the mortgages, others we refer to them as debentures. We have ordinary share capital, we have the preference share capital. In short, there are those sources of finance when as a company you have them, they are repayable over a long period of time. That's why they are referred to as the long-term sources of finance. So as simple as that. Then the other one is short-term sources of finance. Now they refer to those now sources of finance that are repayable over a short period of time, mostly less than 5 years, in most cases even less than 1 year. So they are those sources of finance when you have them as a company, as a business. Yeah, they are repayable over a short period of time, mostly less than 5 years. So those are the two categories under the based on the period. And the example for the short-term sources, we are going to come across them issues like commercial papers. We have bank overdraft. Bank overdraft is a situation whereby you withdraw more than you have in your bank account. So if you have, for example, 2,000, the bank is going to allow you to withdraw 3,000. So the extra 1,000 you're supposed to repay it back, maybe even within that month. That is a bank overdraft. Those are short-term sources. We have another one referred to as trade credit. Trade credit is a common way of borrowing where you don't have enough funds to pay for the goods that you have bought. You buy on credit, meaning that you're going to pay back later. So those are the short-term sources because you're going to repay them even maybe before the year ends or at most less than 5 years. So that is the two categories that are based on the category based on the period, long-term sources and short-term sources. Just need to know long-term sources more than 5 years, repayable period. Short-term sources less than 5 years. Then at least know some examples. You need to know some examples of long-term, some examples of short-term. Examples of long-term we have mentioned, they are there. We have debentures, we have the mortgages, we have the long-term loans, we have the ordinary share capital, preferred share capital. For the short term, we have the trade credit, we have bank overdraft, we have the commercial papers, we even have what we refer to as treasury bills. There are several. I think we can be able to give examples. Now, the other category is now based on the source of generation. And under that, based on the source of generation, we have two again, internal sources and external sources. Even from the ones themselves, I think it is clear. Internal sources are those sources of finance that are obtained from within the company, from within the business itself. Those are the internal sources of finance. They are obtained from within the business. So that's what we are told. I hope now you can be able to see on your screen the notes. That's what we are saying. On our notes, we are told internal sources of finance are those sources which are generated within the business. Now, instead of now going outside and getting now some funds from external sources, we get them internally. And the examples we have retained earnings. Retained earnings are very good examples of internal source. What we mean by retained earnings, when as a company you make profit over the years, instead of using all that profit, you retain some of that profit. That is what referred to as retained earnings. Maybe you have made a profit of maybe 10 million this year. You give some dividends to your shareholders. You use some of the profit, but maybe you remain with 2 million. You keep that, you retain that. That is what referred to as retained earnings. And now, if you need maybe cash in future, you can always go back to the amount that you retained, the one that you're referring to as retained earnings. So another example of an internal source is what referred to as depreciation. In accounting, we discussed depreciation with you. I think we did accounting 1 and accounting 2 with you people. The depreciation we said is the loss of value of an current asset. What actually it means is like a saving. What you are saying is, remember depreciation, we were treating depreciation as an expense in our income statement. Why should we treat it as an expense? We are treating it as an expense as a form of saving. So that in case you have a motor vehicle you have bought today, worth 2 million, you depreciate that motor vehicle every year, maybe 200,000 per year. What you are doing is like you are saving that 200,000 so that when you need another new motor vehicle, you are going to use the funds that you are deducting as depreciation to finance your new motor vehicle. So depreciation is a form of saving because you treat it as an expense in our income statement, but there is no actual expense that is incurred. So what you are actually doing is you put aside 200,000 this year, next year 200,000, next year but on 200,000. So again, when you need another new motor vehicle, you are going to use the funds you have been saving through depreciation to buy your new motor vehicle. That's why depreciation is a source of funds. It is like a savings. So those two examples, you should always use them as examples of internal sources. Retained earnings, that is a profit retained over the years by the company, and the depreciation, that is a form of savings on non-current assets. Then the other category is now the external sources. The external sources now are those sources that are obtained from now outside the business or outside the company. And now there are so many. They are the most common. The ordinary share capital, the preferred share capital, the debentures, the trade credit, the hire purchase, now the loans from banks and other financial institutions. So if you just know what you mean by the internal, what you mean by the external, you have some few examples. The same case with long term, the same case with short term, and the examples, I believe you are good to go. And I think down there, there is a section where we have been given some examples of internal sources, depreciation, funds, surplus. Surplus is the same as retained. Remember in accounting 2, we did non-profit making organizations. And instead of calling it profit, we are referring to it as surplus. So it is all the same. And we have now the external sources of finance examples, the share capital, the debentures, now the others that you have already mentioned. So I believe now those categories are clear, the internal, the external, the long term, the short term, and the examples. Now, in our next discussion, we need to discuss as a finance manager, what are the factors do you need to consider when you are selecting a source of finance? You are the finance manager. The finance manager, you are one of your responsibility is to make sure that you that the company or the business has enough funds at the right time, at the right amount, at the right cost for the firm. So, what are the factors do you consider when selecting a source of finance for a business? So that is what we're going to discuss next. Let me share that page with you. But before that page can appear on your side, we can still be discussing them. And the first factor, of course, that you need to consider is now the cost. I think that should be the first thing that, of course, you consider as a finance manager. What is the cost of that source of finance? What is it cost? If it is a loan, how much are we paying as interest? If it is to do with the ordinary share capital, the preferred share capital, how much are we paying as flotation cost? So you need to consider the cost. It is a very important item as a finance manager you have to consider. So that's why the first one under the factor that you need to consider the source of finance is of course the cost. If we are together, please let me know in the public chat forum nisikuwe najiongelesha hapa. Just let me know if we are together. Those who have joined us right now, welcome. You are not too late. We have just started 10 minutes ago. We have discussed the introduction. We have discussed the categories of the sources of business finance. Now we are discussing the factors that you need to consider when selecting a source of finance. So I need to know in your public chat forum whether we are together. Let me know whether we are together. Does silence means we are not together? And Jockey, are we together?
Yeah, yes. Yeah, we are together.
Kamau Wilson, Evanson, Jiro, are we together? If you can hear me, please.
Yes.
So thank you for confirming. So let's continue our discussion. Let's continue the discussion. We have discussed the first factor is cost. And we have said that as a finance manager, you need to consider the cost of course. Then the other factor is now the risk. I'm trying to share the page on your screen. So the other factor is risk now. When you talk about risk, we are saying that a business is exposed to various kinds of risk. Because if, for example, you take a loan, there is a risk in case of non-payment or non-fulfillment of that loan. What will happen to you as a company? Sometimes maybe you're going to lose some assets. So for every source of finance, there is a risk involved. When you talk about maybe ordinary share capital, remember ordinary share capital, they're going to discuss it. There is a risk of now having more people who can control the business. That is the ordinary shareholders. So for every source of finance, there is a risk related to it. So you need to consider all those risks, and then you take the decision of the source of finance with at least minimum risk. You don't want to go to that source of finance that can lead maybe to a legal action, maybe in case of non-fulfillment of your obligations as a company. To some extent, there will be some risk of bankruptcy. So bankruptcy is when a company is declared bankrupt, that is, they cannot be able to fulfill their obligations. So it is taken over by other people to manage the assets. So risk is a very important aspect that you need to consider. The other factor, as you can see on your screen, I hope so, is controlling. So because as you're going to see, there are those sources of finance that invite more people to be owners to the business. That is ordinary share capital, preferential capital, we have debentures, even lenders, that is the loan. Those sources of finance kind of invite more people to the company to control the business. So if you need to control your business, you cannot go to with those sources of finance. If you want to retain the control of the business, you cannot go with, for example, ordinary share capital. Because with ordinary share capital, it means you're inviting more people to be owners. So controlling is another factor that you need to consider. Does the owner want to retain control of the business? If he or she wants to retain the control of the business, then you cannot go with some sources of finance. Then the other factor is the flexibility. So for flexibility, you need to consider those sources of finance. How flexible are they? Because now, for example, what we are experiencing in the country about the corona pandemic, it has affected so many businesses. Those businesses, they had some loans they were supposed to be paid right now, but they don't have the finances, they don't have the funds to pay back those loans. So is the source of finance that they had flexible in that maybe they can allow for a loan holiday, maybe of 3 4 months. So flexibility is very important. You need to consider that because in some cases, your a business or a company is going to face shortages of cash, especially during those adverse conditions. And we are now talking about now what is happening now. So can that source of finance maybe wait? Can they give them some holidays not to pay back the loan? So the finance manager need to be very careful on selecting a source of finance, but that at least it is flexible. Then the other factor is the flotation cost. I think for flotation cost, we can combine it with the cost that was the cost factor that was number one. So let it not be different because cost, when you talk about cost, we are talking about the various costs of incurred by various sources of finance. For ordinary share capital, for preferred share capital, mostly we refer to them as flotation cost. For a normal loan, the cost is the interest. But when you're explaining cost, let it be in general, that the cost of the various sources of finance. So the other factor that you need to consider are the regulatory rules of various bodies. Because in the financial system, I think in our next topic, we're going to discuss financial markets. We are going to find that we have those bodies that regulate the financial system. Mostly, we are talking about, for example, Capital Market Authority. Mostly, it is a body that regulates the issue of selling and buying of shares at the Nairobi Stock Exchange. We have the central bank and so many others. So they have their own rules. So what are the rules? How does those kinds of rules affect the various sources of finance? So you need to consider those as a manager. So those are the factors that you need to mostly. That doesn't mean they're the only one. If maybe you can think of others, you are free to share in our discussion forum. But generally, those are some of the factors that you need to consider as a finance manager in selecting a source of finance. So before you continue, I will need to take this chance maybe to give you people a chance. If you have a question, please, you can unmute your audio, or you can so that you can ask, or you can maybe type in the public chat forum. So I'm waiting for your question in the next 2 or 3 minutes. If you have a question, you can ask, please. You can use your audio, you can use the public chat forum. Civil Motu, I can see you are typing. And Joki, are you having a question?
No. No.
Emily, are you gone? Ikakata picha. Mutua, you are typing. I don't know what you are typing. Maybe we are waiting for you. Yes, your question is on depreciation parts. Yes. You can maybe unmute your audio, Mutua, so that you can just ask your question, please, through the microphone. Steven Mutua, unmute your audio. Yes, Steven.
When you are explaining about the depreciation,
Steven, we are waiting for you now. Ask your question.
when you are explaining on the depreciation, my network was very poor. I didn't get it.
Steven, can you hear me?
Yes, I can.
Steven Mutua?
Yes, sir.
Oh, yes. Can you ask your question, please?
When you are explaining about the depreciation, my network was poor.
You are?
My network was poor. I didn't get anything.
Yes, those are some of the charges we are expecting, but we are going to manage. Yeah? So
Yeah.
I was saying, Stephen,
Yes.
depreciation is a kind of savings. Remember, in accounting 2 and accounting 1, we were treating depreciation as an expense.
Yeah,
So
expenditure. Yeah.
what usually happens is when you are treating it as an expense, you are kind of saving. For example, when you buy a motor vehicle today worth 2 million,
Yeah.
and you say per year you're going to be depreciating 200,000.
Yes.
What you are doing is you are saving 200,000 per year. Because when you treat the depreciation as an expense, you are deducting it. So it's like you are keeping it aside, 200,000 per year, so that maybe after 5 years, if you need another motor vehicle, you're going to use those funds that you are saving. So in short, depreciation is a form of saving. Ni pesa zinakuwa tu zimewekwa kando. In case you need another motor vehicle, you're going to use that cash to buy that new motor vehicle. So that's why depreciation is a source of funds.
Okay.
Yeah,
Thank you.
Is that clear?
It's clear.
Yes, thank you. Anyone else? So that we continue. If you have a question, please. Anyone else with a question? So it's okay. Let's continue now. We are going to discuss specific sources of business finance, and we have the three major: ordinary share capital, also referred to as equity. We have preference share capital. We have now the debt finance or the loan. Those are the three common we are going to come across for established businesses or companies. So the first one you're going to discuss is now the equity or the ordinary share capital. And you need to understand the issue to do with shares. When it comes to shares, we have two types of shares: ordinary shares and preference shares. Shares is just a certificate of ownership. So what usually happens with a share, you give the company money, they give you a certificate. A certificate is just to tell you you have become an owner of that company. So a share is just a certificate given by the company in exchange for your money now. And when you are given those shares, you become an ordinary shareholder if you are buying ordinary shares. And for ordinary shareholders, there are those features of ordinary shares. There are those advantages of having ordinary shares, both to the holder and both to the company. So in short, we have said that ordinary share capital, they come from ordinary shares. So it is just money received by the company when they sell ordinary shares. Because you have said you can have two types of shares: ordinary shares and preference shares. Now, when the company sell ordinary shares, the money received by the company is now what you are referring to as ordinary share capital. Remember, it is a source of funds. It is a source of funds because when now the company give you that certificate, you need to give them cash. You need to give them money, and now they can use that money with whatever they need. They want to do with that money. So ordinary share capital, money received by the company when they sell ordinary shares. Now when you buy that ordinary share, we refer to you as an ordinary shareholder. When you buy those shares, ordinary shares, you are referred to as an ordinary shareholder and you are an owner of the company. When you buy an ordinary share, you become an owner of that company. So that's why, for example, Safaricom have so many ordinary shareholders. All those ordinary shareholders who run in thousands, they are all owners of the Safaricom. So we have the features of ordinary shareholders, about the characteristics. And when we talk about the characteristics of ordinary shares, when you become an owner of ordinary shareholder, when you become a holder of ordinary shares, one of the characteristics of those shares is they have no maturity period. It is permanent in nature. I think those should be the correct word to use. Ordinary shares are permanent in nature. What that means is when the company gets that money from you, they are not expected to repay back in 5 years or 10 years or 15 years. No. When you buy a share of a company, it is permanent. What you can do is only maybe transfer those shares to another person. But the company can never repay back the money received on those shares. So it is a very good feature or important characteristic. It is permanent in nature. The next one is residual claim on income. What you mean by that point is when you become an ordinary shareholder, you are given dividends when the company makes a profit and has paid for all other obligations. When the company has made a profit and has paid for all other obligations. That's why you are seeing a residual claim on income. So we have made a profit of maybe Safaricom made a profit of I believe I think 70 billion or so. So that 70 billion, they are going to have their own obligation. They are going to make their own obligations. If they had not paid tax, they are going to pay tax. If they had some loans, they are going to pay loans. If they have any investment that they need to make, they're going to make that investment. Then, in case there will be some residue, there will be some balance on that profit. Now they can share part of that profit to ordinary shareholders as dividends. So ordinary shareholders receive dividends only when the company makes a profit and has paid for all other obligations. The other feature is residual claims on assets. This is when the company is being wound up. Being wound up means mali kampuni sasa kama Nakumatt ilikuwa imeishiwa kabisa, it is being wound up now so that it can cease to exist. For these ordinary shareholders, they can claim the assets because you are part of the owners of that company. So in case the company, when it is being wound up, has paid for all the obligations they have, in case there is a balance, there are some assets that remains, ordinary shareholders have a right to claim those assets. The other characteristics is the right to control. When you become an ordinary shareholder, you are the real owner of the company. You can have the power to control management. You can even they can even sack them. They can appoint the directors, the managing directors. If they need to appoint anyone, if they need to sack them, they have the right. That's why we have what we refer to as an annual general meeting. In an annual general meeting, ordinary shareholders go or those owners go to those meetings to make some decisions. And on those meetings, they can control management maybe by sacking them, by appointing new one, by requesting new investment, etc. Another feature is voting rights. Voting rights, ordinary shareholders have a right to vote in the meetings of the company. And it is because we are saying they control the management. So they have the right to vote all times. They have a right to vote. So those are some of the features, very important features. Another feature is they can sack and appoint auditors. They can remove or appoint auditors. Auditors are those people. I think that student did auditing in semester 3. And when you talk about an auditor is a person who comes and checks the books of account, whether they have been prepared as per the standards. Remember in accounting we said we follow some international standards. So remember an accountant prepares the books of account. Who is going to come and verify that what the accountant has done is as per the standards. That is the work of an auditor. So an auditor comes to a company to check the books of accounts and confirm whether those books of accounts are prepared as per the standards. So when for ordinary shareholders, they can have the right to appoint and remove those people who are referring to as auditors. So those are the most common features or characteristics. At least know at least five. At least you should know at least five. Permanent in nature is very important. They receive dividends and the company makes a profit. They have a right to control management. They have the right to vote, and they can sack or remove auditors. I think those would be the very important characteristics or features that you need to understand. So now, after that, I think the others, like no fixed dividends, I think we have said that, we have mentioned that somewhere, that ordinary shareholders, they only receive dividends when we make a profit and we have paid for any other obligation. So the dividend is not fixed. It's not a must. It's not a must for ordinary shareholders to be given dividends. So now we have some advantages and we have some disadvantages. Now, advantages and disadvantages will depend on whether you are talking or on the side of the business or the side of the shareholder. Because, for example, one of the advantage number one you can see there, it is a permanent source of finance. That is, to the company it is an advantage. To the company it is an advantage because they don't need to repay back that money they receive on shares. The other advantage is the voting right. Ordinary, it is to the ordinary shareholders. They have a right to vote, so it is an advantage to them. The other one, no fixed dividend. It is an advantage to the company because they don't have to pay dividends every year. They are not. It's not a must for them to pay dividends. They only pay dividends when the company makes a profit and has paid for all other obligations. So that's why it is an advantage to them. Then we have the retained earnings, and we are told that when the company have more share capital, to be suitable for retained earnings when there are less sources of finance when compared to other sources. So when you're talking about advantages, at least know we are explaining either on the side of the company or the side of the ordinary shareholder. For example, now we have another one here, less cost of capital. So today's cost of capital is a bit cheaper. That is on the side of the company. It is a bit cheaper to get to use ordinary share capital compared to some other sources. Maybe we are going to discuss next preference share capital. So ordinary share capital is a bit cheaper. So at least no 3 or 4 advantages, and I believe permanent is okay. No fixed dividend, it is cheaper, and now shareholders have voting rights. Then the other one are now the disadvantages. The disadvantages, again, they can be to the company or maybe to the ordinary shareholders. Now, one of the disadvantages, it is irredeemable. They are irredeemable now. That is irredeemable, meaning they cannot be bought back. When you buy a share, when the company sells shares to the public, they cannot reach a point and say, we don't need these ordinary shareholders. Let's buy back their shares. No, they are irredeemable. They are permanent in nature. So it is a disadvantage to the company because, for example, if you issued shares, more than 1,000 shares, meaning you have 1,000 people, ordinary shareholders who are owners. It means you can never recall them back. You can never buy them back. So this can lead to what we refer to as overcapitalization, meaning you have so many ordinary shareholders such that it is an obstacle to the company in some ways. Then another disadvantage is obstacles in management. That is true because we said ordinary shareholders, they have power to control management. They can manipulate them. They can sack them. So this will lead to some obstacles in management because as a manager, you fear what are the ordinary shareholders going to say about maybe a decision that you are making. Another one is leads to speculation. Because ordinary shares mostly they are traded at Nairobi Stock Exchange. Those people who watch news, business news, there is that section of buying and selling that usually appear of shares of different companies. And when the price of a share of a company goes down, that creates a very bad image of that company into in the eyes of the public. So it can lead to a lot of speculation. What is happening with the company? Is a company about to fall? Such issues, so such speculations can be a concern to the company. Now, another disadvantage is to the ordinary shareholder, limited income to investor. Because we said, remember, they only receive dividends when the company makes a profit. So they are not guaranteed. They're not guaranteed of dividends per year. So I think again for disadvantages, no at least 3 or 4, and I believe they are clear. So that is ordinary shareholders. That is ordinary share capital as a source of finance, or what we refer to as equity. We have discussed the features, some advantages, some disadvantages. And now you understand it is the money that is received by the company when they sell ordinary shares. Now let's talk about now the second one. The second one is a preference share capital. Preference share capital, what we refer to as quasi-equity. Preference share capital, what we refer to as quasi-equity. And again, for preference share capital, we have they come from the issue of preference shares. Ordinary share capital was from ordinary shares. Preference share capital is now from preference shares. So a company can sell what we refer to as preference shares. And when the company sells preference shares, those people who buy those preference shares, they are referred to as preference shareholders. The money received by the company from sale of preference shares, they are referred to as a preference share capital. Now again, we have some features of preference share, just like we had at the feature at the ordinary shares. And again, one of the feature, again for when it comes to maturity period, preference shares, most of them are permanent, but some are redeemable. That should be very important. Most of them are permanent, but some are redeemable, meaning they can be bought back at a later stage. The company can buy them back. Waseme, we don't need more preference shareholders again. Let's buy back our preference shares. So that's what we mean by it is permanent, but some are redeemable. Now, when it comes to the next one, the next feature, dividends. For preference shareholders, they are given dividends whether the company makes a profit or not. Their dividends is fixed. Their dividend is fixed, whether the company makes a profit or not. Then when it comes to residual claims on assets, they are the first to be preferred. Before we pay our ordinary shareholders, we must pay our preference shareholders first. That's why even the word preference, they are preferred first. Another feature is they cannot now control management. Note the difference here. Ordinary shareholders have the power to control management. Preference shareholders do not have power to control management. And with that, they don't even have power of voting. They don't have any voting rights. They cannot even sack or even appoint auditors. They don't have those rights. So those are the major features of our preference shares. And again, when it comes to advantages and disadvantages, no at least 3 or 4. No at least 3 or 4. One advantage utasema it is permanent, but some are redeemable. Another advantage is their dividends are fixed. They must be paid dividends. Another advantage, they are preferred first when it comes to residual claim on assets. But now some disadvantages, they cannot control management. It's a disadvantage to the ordinary shareholders. They don't have the voting rights. They cannot sack or remove auditors. So at least no 2 or 3 advantages or the disadvantages. And I believe now you can be able to differentiate between preferred share capital and ordinary share capital. So I'll take this chance to give you a chance maybe to ask a question, please, if you have it. Let me know if you want to ask a question. I'm waiting for your question, please. Any question? Faith Dega, can you hear me? Faith Dega? Faith Dega? Kama Wilson? Kama Wilson, can you hear me? Okemwa Collins. Roy Ogiri? Roy Ogiri. Yes, you can speak up if you have a question. Faith Dega? So it seems there are no questions. That is okay. So advantages and disadvantages, you're going to see them in case something is not clear, but I think I've tried to explain. You can be able to give 2 or 3, 4 advantages and disadvantages of each. Now, the other source of finance that is very common is now the debt finance. Debt finance is now the loans mostly. When they're talking about the debt finance is the loan. That's why you're saying it is a fixed return finance. It is a fixed return finance at the cost of the interest, which is paid on the per value of what refers to as the face value. So if it comes to a debt, there is a fixed cost that you pay. That is the interest that we normally know. And debt finance, maybe we have some requirements for raising a loan there. You can go through them. If you have your company and you need to get a loan, there are some requirements, the names of major shareholders, the nature of the product that you sell, etc. And there are some reasons why commercial banks are the normal banks that we know, why they prefer to lend short-term loans. And we have, for example, one of the reasons is long-term forecast are not only difficult but also big, because you cannot be able to know what will happen in 30 years. No one knew 5 years ago what was to happen in year 2020 when it came when what we experiencing now about corona issue. So when it comes to short-term to long-term sources, banks are not very much comfortable because you cannot be able to predict. But for short term, you can be able to predict. And again, commercial banks, they are limited by the regulations of Central Bank of Kenya. So there are those reasons. You can be able to go through them and you can see why some commercial banks prefer to lend short-term loans instead of long-term loans. Now, our interest should be advantages of using debt finance. You may be asking yourself, surely do we have advantages of using a loan? Yes, there are some advantages. And one of the advantages is the interest that you pay on a loan. It is a tax allowable expense. I believe you are doing taxation this year, the semester, and you're going to, when you'll be discussing about the business, taxation of business, you are going to observe that the interest that is paid on a loan reduces the amount of tax you pay as a company. So they become a hidden advantage because you have a loan and interest on that loan, it reduces the amount you pay for tax. So that is one of the advantage. The other advantage is that the cost of the loan is fixed. Remember, not like dividends. Dividends, and for ordinary shareholders, we said, in most cases, if the company makes more profit, they're expected to pay more dividends. When the company makes less profit, again the dividends are reduced. But for the interest that you pay on a loan, it is fixed. What you agreed on remain fixed, whether you make more profit or you make even a low profit. Another one is it does not call for a lot of formalities. It don't need a lot of rules, a lot of procedures or processes. You just need to go to a bank, you agree what they require. If you have them, you are given a loan. Then the next one is it is usually self-sustaining, because when you're taking a loan, you must go with what you refer to as a collateral. You must have a collateral or a security. For example, title deed or logbook, etc. So it means in case you are unable to pay back that loan, then the asset the security that you attach that your loan to can be used to repay back that loan. Another advantage is debt finance does not influence the company's decisions. When it comes to debt finance, Lenders, those people who give out the loans, they do not participate at annual general meetings, that is AGM. So they cannot be able to influence any company decision at all, not like ordinary shareholders. Now we have some disadvantages. One of the disadvantages it is a conditional finance, meaning it is not invested without the approval of lender. The lender, the commercial bank, the bank that lends you money must approve the use of that money. That is a very big disadvantage because it means you must give out your security as a company. Then another disadvantage, if used in excess, it may interrupt the company's decision-making process. Because if you have so much debt, creditors, that is those people whom that you owe them, they will demand a say in the company and say, look here, we have financed most of your operations. We need to be involved in your day-to-day capital management of the business to safeguard our funds that are in your business. Another disadvantage is it is dangerous to use in a recession. Such a condition may force the company to receivership, like what happened with Nakumat. They had no funds to pay for the creditors to service the loans that they had. So at that, they went at the receivership. Another one is it calls for securities. We have seen that you need a security or collateral for you to obtain a loan. Another disadvantage, it is not available for everyone. It is only available for specific ventures and for a short time. Not all companies can access loans. No. Very available for specific and for a short term. And the other one is the use of debt finance may lower the value of a share. Remember, we have talked about shares, and we have said shares are traded at Nairobi Stock Exchange in our case. And in case you have so much debt, the perception in the eyes of the public may not be good. So that can lower the value or the price of the share in the market, which can be another disadvantage to the company in the future. So those are the disadvantages and the advantages of debt finance. I believe now I have clearly understood the ordinary share capital, the preferential capital, and the debt finance. Now, after that, we have now some summarized differences between debt finance and ordinary share capital. We have already discussed them above. Now you would want to have a summarized point of the differences between debt finance and ordinary share capital. And one of the points at ordinary share capital, it is permanent. We say that, but for a debt, you have to refer. You have to pay back the loan. At the ordinary share capital, the return, that is the dividends, they are paid only when available. But at a debt, interest is fixed. You must pay the interest. Another advantage, dividends, they are not tax allowable. Dividends do not reduce the amount of tax you pay as a company. But for interest, we have said that interest is a tax allowable expense. It reduces the amount of tax that you pay. Another difference, it is unsecured for ordinary share capital. You don't need a security or a collateral for ordinary share capital. But for a debt, you need a security or collateral. For ordinary share capital, they carry voting rights. For debt, no voting rights. So if you know 5 or so differences, you'll be good to go. Then the other one, we have similarities between preference and equity. We have discussed the two. Preference share capital and ordinary share capital and equity. We have some similarities of the two. We have said both may be permanent, but some preference share capital to December, they are redeemable. Both are unsecured. You don't need security. Both are traded at the stock exchange, in our case, Nairobi Stock Exchange. Both, they are raised by public limited companies only. You need to note that not all companies, not all businesses can obtain or can raise money through issue of ordinary shares and preference shares. For example, what we did in accounting to partnership, they cannot issue shares. So they are only raised by public limited companies. And then both carry residual claims after debt when you have paid all the other obligations and we are winding up a company, we can claim those debts, we can claim those assets, sorry. Then both the dividends are not a legal obligation for the company to pay. You cannot take the company to a court of law because they have not paid dividends. It's not a legal obligation. Then another summary you have down there is differences between preference and equity. Preference and equity. Up there we have similarities. Now we have the differences, and we had mentioned them. Preferential capital, no voting right. No voting right. Ordinary share capital, they have voting right. Ordinary share capital, they have power to control management. Preferential share capital, they don't have power to control management, and some others that have been added there. And then you have another summary down there, similarities between debt and preferential capital. Again, the same. The debt, we have some similarities between now the borrowing loan and the preferential capital. Both have fixed returns. Why are we saying that? Because we said dividends must be paid for preferential capital, and for debt, interest must be paid. Both will increase the company's gearing ratio. We are going to discuss this gearing ratio in another topic. So I think maybe at this level we may not be able to understand what we mean by gearing ratio, but it is just a ratio that is used by a company to measure how much they are depending or on borrowed funds compared to funds from the owners. Both are usually redeemable, they can be bought back. We have said some preference shares can be bought back. They do not have voting rights, etc. Then there we still have another summary down there, differences between preferential capital and debt. Just like we have similarities up there, we have differences. For debt, interest is tax allowable, but for dividends, they are not tax allowable. I believe you can now not be able to go through those points, and they are going to be very simple to understand. Interest for debt is a legal obligation; you must pay interest, but for dividends, is not a legal obligation. Debt finance, it is always secured. Preference tunasema it is not secured. So if you understand those items, what we have discussed in details, even if wakuulize the differences between what and what, if you know what it is, you know the features, you can be able to differentiate them, you can be able to give the similarities. And I hope that is clear. Then there is another point down there why it may be difficult for small companies to raise debt finance in Kenya. So in most cases, if you have a small business, before you can access a loan in a bank, it can be somehow difficult. So why is that? We have lack of security, we have ignorance, we have lack of security, meaning most people do not have the collateral, the loan books, the title deeds, some assets maybe to attach the loan to. Ignorance, people do not know the finances available to them. Another, most of the businesses are very risky. No commercial bank will be willing to risk their money with them. Then their size being small, they tend to make them unknown. So they're like unknown, hawajulikane, and by those lenders. And then another cost of finance may be high because you don't have security, your business is very risky, so the cost of that finance becomes too high and people get discouraged. And then small loans are expensive to extend by bank. I think that should be under the cost of finance. And then lack of business principles. You are just managing your business in a Kenyaji way. So no, people cannot be, a lender cannot be able even to evaluate your performance, cannot be able to follow up with some other issues. And then they have suggested some solutions to the above. There should be diversification of securities because most people do not have those title deeds and the log books and some assets to attach to a loan. So can we diversify securities? For example, we can have guarantors. Instead of giving you my log book, can another person guarantee me? Then another is education. They need to be educated on the various sources of finance available. Then the government should set up a special fund. Like we have the youth fund, we have the women's fund. Those are special funds set aside to help such people. Then we encourage formation of circles, cooperative societies, because in those circles, you can be able to access maybe a loan easily compared to bank. And then we request bankers to follow up the use of these loans because if they are not paid back, they discourage other banks to give out loans. Then what we have discussed about the preference share capital, the ordinary share capital, mostly they are sources of business finance for established companies, those companies that are large in size. Now, what about those small businesses? You want to start your own business. You want to start your own hotel, your own IT firm, your own small business from scratch. Where do you get those sorts of funds from? That's why you have highlighted there. You can get them from family and friends. You can even get it from a bank. We have others that you get referred to as business loans that are now specialized loans. You can even get consumer loans instead of going to a company. Take a loan for business. You take it as a consumer loan. Then you can do whatever you want to do with that cash. Grant is now when you are given money mostly by non-profit making organizations or the government to finance your business. Grant, you are not supposed to pay back that money or from maybe your personal savings and any other sources that you can get. So generally, that was the first part of the introduction to business finance. The three common: ordinary share capital, preference share capital, the debt. Then we have similarity differences of those three. We have they have been highlighted there clearly. You can be able to go through them and understand. We have even discussed the sources of funds for small businesses. But remember, those are not the only source of funds or source of business finance. We have now the others that we are highlighting: the debentures, the mortgages, the retained earnings, the hire purchase, and the others. And I, for those, I needed you. I think they were form of your assignment. They were part of your assignment. I believe I have given that assignment in the photo. You just need to explain their meaning in summary. At least give two or three advantages of each. Is for example, is a debenture. Give us what you mean by a debenture. Tell us maybe two or three advantages of the venture and disadvantages of the ventures. Do that for all the other sources of business finance highlighted in the quizzes. And I believe that should be the topic: sources of business finance. I think now I can wait. If you have a question, maybe you need to be a point to be clarified, or maybe how we can improve our discussion. We can use now this chance maybe for 5 minutes or so 10 minutes to discuss and interact and see the way forward before we can end the meeting. So you can unmute yourself, please. You can even share your video if you can. At least I need to see your faces. I cannot remember. I cannot be able to connect your names. Add your faces from our interaction in accounting 2 and 1. So you can now share your video. You can now unmute your microphone.
Yes.